A few thoughts about trends are needed, even though we did mention trends in the basics section. We need to differentiate between the different types of trends. A trend can be a rising trend in which support and resistance diagonally rise, a downtrend in which support and resistance diagonally fall, and a ranging trend in which support and resistance are usually parallel and the price lines ranges from one edge to the other. We sometimes call that a sideways trend. Trends can also be measured over time. A long-term trend is one that's measured over at least 52 weeks. A medium-term trend covers about 3 months, and a short-term trend is anything under 4 weeks. Obviously, patience must be practiced depending on your own personal time frames for trading. Now, let's discuss trend patterns. A simple one is the gap, the difference in price between one day's closing price and the next day's opening price, or the close and opening consisting of a week. A gap is usually the result of breaking last-minute news or something that happened over the interim. Prices often return to the mean. If they don't, the gap is called a runaway gap or a breakaway gap. 3 popular price trends frequently discussed are heads and shoulders, double top, and double bottoms. All 3 are used to predict market reversals. In the double top, the price rises, drops a bit, rises back a bit again, and then drops with a surge. The double bottom is the inverse. The head and shoulders is slightly more dramatic. A rise, a small drop, a larger rise, a return, a small rise again, and then the big drop. Now, remember support and resistance? Those lines across a chart that describe when the market believes an asset is overbought or oversold? The line an asset usually has a hard time crossing? Well, when it comes to charting support and resistance, you can use flag patterns in which support and resistance develop in parallel, or triangles which describe a consolidation of price and factors their fluctuations. A bullish triangle is comprised of a horizontal resistance level and an ascending support level. In a bearish triangle, support continues horizontally while resistance descends diagonally to meet it. And in a symmetrical triangle, support and resistance converge along a diagonal. Before we leave this section, let's talk about the Elliott wave principle. A lot of technical analysis is based on the theory that the highs and lows of behavior are reflected in the highs and lows of the marketplace. You might even call that a bipolar approach to market investments. Ralph Nelson Elliott talks about this theory in his book, The Wave Principle. He said the rhythmic procedure of these waves can be extrapolated into the future. Now, Elliott was, after all, an accountant and not a psychologist, and though his theory may sound far-fetched, the concept that the resulting waves are formed by motive and corrective phases is quite precise, and the resulting psychological patterns of bear markets is surprisingly revealing. The Elliott wave principle describes 9 possible cycles through which a pattern may be recognized: the multi-century grand supercycle, the multi-decade supercycle, the multi-year cycle, the multi-month primary cycle, the multi-week intermediate cycle, the multi-day minor cycle, the multi-hourly minute cycle, multi-minute minuet, and the multi-second subminuet. And indeed, you will find very few analysts, technical, fundamental, or otherwise, who won't swear by this theory in identifying bull and bear markets. They have specific stages, a specific pattern, and they occur with almost alarming regularity. But that's a topic for another show. Next, candles and how they can light your way to financial success.